Hey, it's Lewis here and welcome back to the channel, and in today's video I'm going to be analysing Alphabet stock. I'm going to be using TIKR terminal to review the financials, and then I'll be putting these numbers into my analysis checklist to ultimately decide if this business is of good enough quality for me to be interested in. After that I'll put the free cash flow into my DCF to come to a fair value of their stock. Let's get straight into it. So who are Alphabet? So Alphabet Inc. is an American multinational technology company headquartered in California, and it was created through the restructuring of Google in 2015. Essentially, Alphabet became the holding company for Google and the other businesses. So yeah, Alphabet itself, everyone knows who they are, they own Google. So yeah, they're one of the biggest companies in the world, the biggest tech companies alongside Amazon, Apple, Meta and Microsoft. They wanted to create Alphabet so the focus wasn't just on Google itself and they could focus on the other businesses as well. The company itself is traded on the Nasdaq and it's a component of the S&P 500 index. Now let's take a look at the sales for Google, or Alphabet I must say. We'll start with the sales per business, and yeah, so most of the sales for Alphabet is Google, hence why I said Google. 2021, so Google services made up 92% of revenue, Google Cloud made up 8%, and then the rest of it is just other bets, so not much going on at all there. Basically the search engine rules and makes most of their money. Sales per region, so a little bit more interesting here. So the United States makes up 46%, so half the sales basically come from the US. EMEA, guessing that means Europe, something else, so 31%. APAC, that means Asia Pacific and something else, so 18%, and the rest of it is, most of it's the Americas. Now let's take a look at the financials for Google, Alphabet, using TIKR terminal, and we will start with the income statement, of course. So yeah, from 2016 to 2021, massive revenue increases. You're talking 20% revenue growth year on year, apart from 2019 and 2020. Revenue growth is slowing. 2021 was amazing stuff, but yeah, company's revenue has been growing massively over the many years. It's starting to slow a little bit. COVID had a big impact on the upside for the revenue, but we will see what happens. You don't expect massive growth for Google from here probably, but it's good to see. Just a fantastic business, for sure. So gross margins pretty solid, declined a little bit over a few years, want to stay probably quite consistent as we are. Net income, so yeah, very profitable business. Net income has been very decent. 2021 was a fantastic year as well, 29% net profit margins. It's looking like we'll end up around the 20% long term though. What else do we look at? So shares outstanding, we want these to be going down over time. It rewards us as shareholders, it gives us a bigger piece of the pie. So yeah, ever so slightly decreasing the share count, so that's good news. That's about it for the income statement. Onto the balance sheet. Quick metric, cash on hand, cash generating machine, cash on hand going up, love that. Long-term debt, don't think Google has any. Oh, there's a little bit, but not much. Basically negligible for the business. It's increased a little bit, not a big deal because we've got so much cash. What cash do you have again? 140 billion, oh my god, 140 billion of cash. And what sort of long-term debt? About 13 bill, means nothing, not a big deal. You wouldn't want them to load the balance sheet with debt, but it's not a big deal for Google, let's be honest. Return earnings over time have gone up, expected. Cash flow statement for the next bit. So cash flow from operations minus capex is free cash flow, and you can just clearly see that this is going up, and we'll see it from my analysis checklist in a bit, which is awesome. Yeah, no dividends for Google because they just reinvest the cash. Totally the right decision to do so when we've got the business to grow, etc. Repurchasing shares, 50 billion of share repurchases. 50 billion. So they're increasing their share repurchases and stuff, which is awesome. Then onto the ratios now. I like the ratio section because it tells me a bit of a story of the business based on the financials. So yeah, return on capital, very solid stuff. I like to see 15% or above. In 2021 it was at 27%. Unsure if this can be continued, but it's looking decent, isn't it, really? High gross margins, net income margins as well, not too bad. And free cash flow margins aren't too far off either. Onto the debt situation, so current ratio. This company has no problem with debt. Let's just say that for now. Current ratio, equity ratio, absolutely solid. Cash conversion cycle below 60, so I think that's a good sign. Then long-term debt to capital, like I said, this company does not have to worry about debt at all. Only 10% of their capital is made up of debt, so that is really, really good. But yeah, anyway, if you like TIKR Terminal and you're interested in using it, hit the link in the description down below and have a go yourself, because it's a fantastic platform. All the financial data is really clean and easy to use, so yeah, enjoy using TIKR Terminal. If you are enjoying today's video, then why don't you book in a one-to-one coaching session with myself? In these sessions you will learn how to analyse a company using fundamental analysis. As well as this, you will learn how to value a company using a DCF model. Value investing is the art of buying stocks which trade at a significant discount to intrinsic value. Value investors like myself achieve this by looking for companies on cheap valuation metrics, typically lower multiples of their profits, assets, and cash flow as well, for reasons which are not justified over the long term. Billionaire value investors such as Warren Buffett, Charlie Munger, and Joel Greenblatt have all used these timeless concepts to beat the market over the long term. No financial advice will be given on these calls, financial statement analysis and business valuation, education only. I will see you there. Now let's take a look at the genuine impact stats for Alphabet, and we'll start with the quality metrics. So yeah, from what you can see here, very high quality business. It ranks very high. It ranks in the 400, so it's one of the highest quality businesses on the platform. So yeah, profitable, profitability very high, financial strength very strong, capital allocation poor. Don't agree with that last one, but hey ho. Yeah, very, very good, high quality business. Value wise, it's looking expensive based on these metrics. Income statement, balance sheet, cash flows looking expensive, very expensive, medium. Yeah, I would debate that as well, but you know, interesting to see how Genuine Impact does calculate these things. Historical growth, very high. You know, you can't knock Google for growth, even if the growth will probably slow into the future. Well, it will slow into the future. You know, credit to them for growing as much as they have done. But I think overall, you can just see it's a good quality business based on these metrics. Now let's have a look at my analysis checklist for Alphabet. So we will start with my first pillar, so profitable, high returns on capital using low leverage. So returns on capital, I like to see 15% or above for a 5-year average, and Google smashes this out of the park with 19%. Solid stuff. Gross margins and net margins also do really well. Pretty good net margins, let's be honest. 20% plus is always a good sign. Free cash flow margins not quite there, but not too far off net margin, so over time these two figures should be the same. Current ratio, you know, debt, we've already spoken about it. There's not much debt going on with this business, lots of cash, so nothing to worry about, but it's a really, really good green flag. Proven ability to grow, so the company's just grown massively over the past 10 years. Yeah, awesome stuff. Great capital allocation, so what is the company doing with their cash to reward shareholders? Long-term debt repayment, issued a bit of debt, not too much to worry about. They could probably pay it off with a few months of free cash flow, so it's nothing to worry about at all. Shares are decreasing, so they are rewarding shareholders by making the pie smaller, and meaning us as individual shareholders own more of the business, so it's actually a win-win. The best way to return capital to shareholders is share buybacks at good prices. Let me just say that. Dividend growth, so yeah, they don't pay dividend, so maybe a bit harsh, but I put this metric in anyway. Good acquisitions, so I basically just don't want them to be impairing goodwill, because if you impair goodwill, it essentially means that you have written off assets, and you usually only do that when you've made bad acquisitions, and that's bad. That's bad capital allocation in my book. So yeah, they passed this one. Overall quality score of 87%. No surprise. Yeah, awesome business. Very, very good business. One of the best out there. Could be the best business in the world. If anyone said that, I would not argue against them. Google has such a big moat. Don't say that often about companies, but Google has a proper moat with Google search engine, etc. So anyway, buy at a fair price. So Currently the PE ratio and price to free cash flow ratio is above 20, but it doesn't really matter if the growth is there in the business. And currently for a 10% return, we're looking at a share price of about $2,300 pre-split. So yeah, from current levels, what we're looking at, it's just about there really, for a 10% return. Yeah, we'll go to my DCF valuation now, and yeah, reasonable growth into the future. So I estimate 3 years into the future, 10% graduate return, and then from, after the first 3 years, 2.5% growth into the future. So yeah, add the net cash of the business on, and we're looking at a share price of $2,300. Yeah, absolutely solid. If you think 10% return is good enough for you, then it's looking in about that range now. But yeah, overall, very good high quality business. If you can get this business, let's say if you got it below $2,000, with a bit of a margin of safety, absolute win-win in my book. High quality business, don't make it complicated. Yeah, simple as that really. So there we have it. That was my full stock analysis for Alphabet. And if you enjoyed today's video, then please subscribe to the channel. Thank you very much for watching. I will see you next time.
Thank you for watching. As always, it would be amazing if you could like, comment and subscribe to the channel if you enjoyed this video. I will see you in the next one. However, you can check out some of these videos.